Good afternoon, and thanks for joining Washington, D.C.-based Jennifer Schaus & Associates in our Get Farsighted in 2020 complimentary webinar series. As you know, the FAR, or Federal Acquisition Regulations, is the rulebook that the federal government must follow in making purchases. Our webinar series pulls from contracting experts to explain each part of the FAR. It is complimentary and recorded. We'll post all the recordings on our website and YouTube channel, where we have over 300 government contracting webinars available for download. A special thanks to our webinar partner in the series, the National Veteran Small Business Coalition Education Foundation. Please visit their website to learn more about the organization. We would also like to thank our friends at Open the FAR for their sponsorship. If your organization is interested in sponsoring the series or one part, please contact hello@jenniferschaus.com. And now a little bit about us. We work with primarily large businesses to help them navigate the federal marketplace. We work with both product and service companies as well as software firms. Our clients span the globe and include publicly traded organizations in a variety of sectors. We provide market analysis reports, contract administration, contract vehicle assistance, and more. All of our services can also be built into a training course for your team. Learn more about us on our website. And now we would like to let you know about some ways to reach the government and government contractors through us. We offer advertising and sponsorship opportunities through our weekly newsletter and also in our webinar series. For pricing or to place an order, please email us at hello@jenniferschaus.com. Now let's move on to learn a bit about today's speaker, Jeff Shapiro. You can find his contact information on the screen here. And today we are covering FAR Part 31 with Jeff. Thank you so much for joining us today. We're really thankful for your participation in the series. The floor is now yours. Please let me know when you're ready for your next slide.
Sounds good. Thanks so much for the introduction, Arlen. All right, let's move on and get to today's learning objectives. Well, welcome everyone. I'm really glad you can all join me today. Got a lot to cover in a little bit of time, but I'll tell you that typical FAR 31 courses can be a day or even a week-long type course. So I'm going to condense that all and give you the nuts and bolts of what you really need to know. But if you need more details, there's a lot more here to unpack. So today we'll talk about the importance of this part, and I'm going to teach you about what the difference is between allowability, allocability, and reasonableness, and the related overarching concepts for those. We're going to talk about what an expressly unallowable cost and what it means if you're a contractor, what will happen to you if you get caught claiming them, and what that means. And then we'll get into some specific risky areas of costs, and there's about 50 cost principles about specific areas. So there's obviously not enough time today to cover them all, but I want to just cover at least a couple just to give you a flavor for what you're in for when you're trying to figure out, is this cost allowable? So I'm going to try to get you there today, and this is just the beginning. And then finally, some best practices on how to identify unallowable costs. Let's go to the next slide. All right, so why is FAR 31 so important? Plain and simple, it says in FAR 31-103 that the cost principles and procedures 31.2 are to be used, and it's going to be used in any cost reimbursable contracts, cost plus, fixed fee, award fee, any of those. T&Ms, we're talking about the reimbursable part, the dollars part, not the hours part. When you're negotiating indirect cost rates, so if you're doing submitting provisional rates or any forward pricing rates, unallowable costs should be excluded from those pools. And then when you're proposing, negotiating, or terminating contracts under terminated contracts, that's a very specialized area for a whole nother day. But if you're on a fixed price contract that gets terminated, it turns into a cost plus contract. Then a bunch of other contracts that's here. But I also want to make sure you see that fixed price contract can be subject to FAR 31 cost allowability, and that usually comes into when you have to submit certified cost of pricing data, and when you're pricing up your rates, your indirect rates, or even your direct rates, you need to consider the impacts of unallowable costs. All right, next slide. So how do you determine allowability? And that's outlined in 31-201-2. These key factors are what needs to make a cost allowable. And I know we're going to repeat what some of these are in a bit, but you need to essentially check all these boxes in order for a cost to be allowable under in federal government contracts. The reasonable allocability I'll talk about momentarily. Is the cost CAS compliant? So if you're a contractor in your firm, it has to follow the cost accounting standards. That's what CAS stands for. you need to not only be compliant with what's within the FAR, you also need to be compliant with the regulations within CAS. And the good news, I'm here to tell you that if you're following FAR, you're most likely going to be CAS compliant, but then are you following your consistent practices? That's including your disclosure state if you're fully CAS compliant. Anyways, so much here to get into and so much to cover. Terms of the contract, that's a really big factor. Whenever you're awarded a federal contract, make sure you're really parsing out each of your contracts as awarded to make sure there aren't specific clauses that make certain costs unallowable. One good example that's almost in many contracts is overtime premiums. So if you have part-time employees who are working direct on contracts and you ask them to work overtime, your normal practice may be to pay those people overtime, and you may not be able to collect on the premium that you're paying on those contracts. So go look at the terms of the contract when you're allocating those costs to the contract like you should. Don't be looking to bill them, because an auditor or the government, when they're looking at your invoice, may see that and say, hey, wait a second, there's a term that says you can't do that. So there's often indirect rate ceilings, a whole bunch of different things that could make certain costs unallowable. You got to look at your agency specific supplements and any other, and making sure that any cost that you're claiming, you need to have the documentation. I mean, this is the mantra, and I'll get to it at the end. But when you're in government contracting, it's all about the documentation and what do you have to back it up to substantiate why this is an unallowable cost. If an independent person or the government cannot figure out what the cost was, why it was charged, why it was allowable, then this part of the FAR it tells its contracting officer to make a determination on your behalf. Is that how you want to treat your costs? So something to keep in mind. All right, let's keep going. Next slide. Reasonableness. This to me is all about the Washington Post test mostly. So like you're claiming a cost, the golden toilet seat and all that kind of nonsense, the $1,000 hammer. If you're charging costs that someone else, outside your organization goes, you paid how much for what? That's essentially reasonableness. What it specifically says in this FAR part is about the prudent person, and that they're responsible when you're taking responsibility for what you're doing, or you're consistently doing it within your company's practices. So, if you're thinking of yourself as a profit earning business, are you buying stuff under your cost plus contracts the same way you're doing under your fixed price contracts? So because a lot of people see those cost reimbursable contracts as blank checks, and it really should not be done so. You should have a certain amount of rigor in your purchasing practices such that you're spending such that you can still stay within budget, and contracts that have a fixed cost reimbursable plus fixed fee should incentivize those practices to keep the cost reasonable. But not everyone acts the same. But bottom line, keep that in mind. Keep these kinds of things in mind when you're making sure that the costs that you're claiming are reasonable. Next slide. Allocability, good old accounting term, but those who are outside accounting may not understand this principle very well. This is all about making sure that a certain cost as is incurred gets applied to the contract in an equitable way. So, we hear the term final cost objective, and I didn't actually put that on the slide, but final cost objective is a fancy way of just calling a project or a contract. So when you're thinking about, does this cost belong specifically on a contract, or is it an indirect cost? Think about what the causal or beneficial relationship of the cost. If you're incurring a cost to go to training, is that job training for that specific person? Is it just for the performance of that one specific contract? Well, it could be. Maybe for that certain contract, that contract says, hey, I need you to go to this training session and learn this very specific interagency requirement. Yep, could be a direct cost. However, if it's a training on company-wide ethics or timekeeping, well, that sounds like that's something that benefits multiple contracts and makes sure that the company stays compliant with FAR. Hello, this is why we're doing this, right? So then it becomes an indirect cost, and probably in most cases belongs in the company's either G&A or overhead pool. So yeah, so you need to consider that causal or beneficial relationship when it comes to allocability and how whether or not it belongs there. So you're incurring a cost on behalf of another organization. Say you have multiple subsidiaries, you're going to have to transfer that cost out of your company and not have it improperly allocated to a contract that you're working on. All right, let's move to the next slide. So let's better understand it. So I think this Venn diagram does a good job of showing how everything links. A big concern that the government has is the spending that you're incurring on behalf of your whole business. Is the government getting its fair share? And this especially is worrisome when a company does commercial business. The biggest concern. I work as an auditor for a lot of my time in my current position, and the biggest thing I tell my teams is, is that company using government funds to help subsidize an unprofitable commercial contract? So, if they're doing 25% of commercial work and somehow, 90% of indirect costs are getting allocated to government contracts, that's probably not equitable. So you need to think about that and make sure that there's an equitable way that costs are being segregated, the indirect costs are being segregated between commercial and government contracts. That's going to be something that's always highly scrutinized. So the common issues that I list here, also include, understanding how the use of advance agreements. So, is there a specific way you're accounting for a special kind of cost, and are you, make sure you continue abiding by the terms of that advance agreement. I talked about those rate ceilings. There may hit a ceiling in a certain contract, but you can't then just take the rest of the unbilled indirect rate costs and throw it onto another contract. That would be inappropriate, and you get caught for doing that. And then commerciality. So that's an interesting concept that usually you use a fixed price or commercially determined market-based price for a product for your revenue and billing purposes. However, you still need to allocate costs, especially if you're working on government cost-based contracts. You still need to allocate the costs that relate to the procurement or providing of the commercial services or goods in order to make it fair. And then contract mix. Oh, geez, there's the allocability between fixed price and cost plus contracts. I know there's always a temptation for a contractor to figure out, let me make sure this is something that I can allocate to my cost reimbursable claim or contract versus my fixed price contract. Because, well, of course, I want to, I get reimbursed for each dollar paid. And then when you have multiple contracts and multiple customers, the DoD doesn't want to pay for costs that the DOE, the energy, is paying for. So lots of different issues here. Got to keep in mind to make sure that everyone is getting their fair share is what it comes out to. All right, next slide. Credits. This is one that's hot in the news now just because of the PPP loans. Just know that for any credit that you receive, don't just quickly throw it into miscellaneous income. Make a determination whether or not it's a credit against a cost that has been incurred. If it is, then you got to make sure you put that as a credit to the expense account and not to your miscellaneous income account. Next slide. Accounting for unallowable costs. Wow, this is a very hot topic, obviously. How you actually account for unallowable costs. And FAR is not going to be very specific on how you do that. But generally, I'm here to tell you that contractors should have segregated accounts for unallowable costs. And then this concept of directly associated costs is a unique one to government contracting, obviously, that, for something that you do an unallowable activity, a very easy one, and I know some of you listening may not be aware of all the unallowable costs, but I'll try to make it simple as possible. Entertainment, as you may imagine, you take someone out to a ball game, when we're recording this is the time of COVID, so hopefully by the time a year from now when you're listening to this, we can actually do this. But anyways, you're taking someone to a ball game, and you might be talking about business development opportunities, and from a business standpoint, it could be a deductible, maybe a tax deductible expense, or at least partially tax deductible expense, and it's a legitimate business activity. But at the end of the day, what you're doing and the activity that's going on is essentially an unallowable activity. It's entertainment. So all the labor costs, if that person puts that time in their timesheet, and they probably should, is an unallowable time. The taxi cab or the Uber that the person took to get to the ballpark, yep, that would be unallowable as well. It's all associated with the activity of entertaining. So I gave you another example down below. All right, let's keep going. We got a lot to cover in a little bit of time. Expressly unallowable costs. I definitely want to take a minute to talk about what an expressly unallowable cost, why this matters. So I gave you the definition about what it is. And essentially, when you read the FAR, there's essentially no question that thou shalt not do this. It says, such and such is not allowable, or it is only allowable when you do this. So as seen there, as I talked about there, it says, leaves little room for differences of opinion whether or not it meets the allowability criteria. So purchase of alcohol is unallowable. Says it very simple. The cost of entertainment, unallowable. Purchase a gift are unallowable. Those are all easy examples of expressly unallowable costs. You go to the next slide. There's some that are essentially implied. Next slide, please. So it could also, so here's the direct examples. Like I said, the contributions, the alcoholic beverages, bad debt. There's so many more. There's so many of these examples. I mean, there's also examples at the agency supplement levels. So for instance, HHS doesn't allow for independent research and development costs. So you see that clause in your contract, realize that any costs allocated to HHS, you're going to have to take out that part of your costs, or else be subject to being deemed an expressly unallowable cost, which I'll explain what happens if that happens to you all. All right, so next one, we'll talk about the indirect. Next slide, we'll talk about the indirect terms. So, for instance, there's where it says, for the example of for key man insurance, the costs of insurance are only allowable to the extent that. So essentially says you can do this if it meets this condition. If it doesn't meet the condition, therefore it's unallowable. So that, again, you can plainly interpret that if I claim an insurance that benefits the life of an officer and the company gets paid, yep, that's an expressly unallowable cost. So if you're having a hard time, if you're thinking about and maybe you're arguing with an auditor about whether something is an expressly unallowable cost, well, I gave you a link to a memorandum for regional directors about an audit alert for expressly unallowable costs, where you can go see the detailed list about what the government sees as being determined what an expressly unallowable cost. All right, so what does it mean if a contractor claims an expressly unallowable cost? Next slide. Well, you could be assessed the penalty. So not only do you have to pay back the amount of the unallowable cost, the $100,000 we found in alcoholic beverages. Wow, must have been a heck of a party. Well, you not only need to pay the $100,000, but you also have to pay 100% as a penalty. So you're going to be paying $200,000. Oh, by the way, yes, you're also going to get assessed interest. So those alcoholic beverages were bought 4 years ago. You're going to have to pay compounded interest on top of that. So yeah, it's a big deal. It could cost your company a lot. And there's even where you can get treble damages for costs in which they've been already deemed unallowable prior to submission of proposal. So say you wanted to propose something, you wanted essentially a judgment from the contract officers. What if we did it this way? Or, here's this legal case, and you wanted to get an advance agreement from a contracting officer. Hey, if this happens, would you allow these costs? If you get a letter from the contracting officer that says, nope, I would not deem these to be allowable costs, and then after you get that letter and still submit your cost submission that includes those costs, a contracting officer can interpret that as being that second level of assessment of a penalty. So be really careful with those kinds of situations. I mean, a better example is even when other incurred costs are being negotiated and contracting officer says, yeah, that's a cost that's penalizable. Well, that could also be a situation. But good news, for the tiny little things here and there that you may not catch everything, $100 here and there of a meal that could be deemed as entertainment. yeah, you might be asked to be paid that $100 back, but they may waive the penalty because it says very specifically within that 427095 that the contracting officer has the ability to waive the penalty. And there's also that small little thing about unintentional error. You're gonna have a hard time proving that because you're gonna talk about how great your controls are and I don't claim unallowable costs. Well, yet something happened. How is that an unintentional error? So that one's a tough one. Anyways, avoid the penalties, take out your expressly unallowable costs from your indirect costs. All right, next slide. All right, so I'm going to quickly go over a couple of risky FAR clauses. Like I said, we're limited in time, so I can't really go into a lot of them. So I think talking about compensation, those professional services and travel costs are good overviews of more complex principles within FAR 31 and why, like I said, there's multiple references to these types of costs, and there's a lot more judgment that has to be involved with it, and lots of documentation. Oh, have you heard that yet about government contracting? All right, let's go talk about compensation. Move next slide. All right, here's all the separate sections within this FAR principle. I'm obviously not going to cover all of them, but let's talk about the ones that I see people are challenged with the most. Next slide. Usually when you see the general section of a clause, you quickly glance over and you're like, whatever, no big deal. This one, I would not be so fast in doing that. It talks about needing to have an established compensation plan, and if you make any major changes to that, you're actually supposed to tell the ACO. There's no level of size of business where if you're changing how you give offers on a company-wide basis. Don't go crazy with this. This is an overall thing. Then you have to notify. Very more common is the biggest thing I want to point out here is the one in the middle about because you call it compensation doesn't make an unallowable cost allowable. So I can't tell you how many people have said, hey, listen, it's part of his compensation. We give him $10,000 to go entertain climate. Oh, I heard entertain. No, that part of the compensation is now thrown out. So one overriding principle about FAR 31 is, multiple FAR clauses may be involved, cost principles may be involved, but ultimately, what is the nature of the transaction? And you might be doing business development, you might be doing some selling, but ultimately, if you're doing that all at a ball game, like I said before, they're probably all gonna get thrown out. Other special consideration, like I say here, it says very specifically that if you're an owner-operator, owner-manager within the company, you're going to be closely looked at. And that's not to say that owners can't be compensated and not be compensated, at the 75th percentile, but you're going to get very closely looked at. So be careful, do your homework, do the market research, get salary survey data when you're determining what owners should be paid in terms of compensation. All right, let's move on. Next slide. So reasonableness, and like I talked about, there's the general FAR clause about reasonableness. Well, this specific FAR clause, and first cost principle talks about its own reasonableness. And this is usually where we talk about executive compensation, or at least other highly compensated individuals like SMEs. The test is supposed to be, are you paying these people within a reasonableness standard of people who are in the same size, the same industry, same geographical area, and doing same kind of work under non-government under comparable circumstances. So bottom line, what homework are you doing to make sure that what you're paying is indeed within a market rate? We always throw that number out. Oh, it's the market. So what the market allows. Well, the person at his last job was making this much. Now we're going to pay him 20% more. Okay, that might be their approach, but ultimately, is that what the market really pays? Or is you just so, want that person so badly, you'll pay whatever it takes? So do what's right and make sure you have independent data that can substantiate the rate that you're paying, especially the higher rate employees. And given these circumstances, that's exactly what the auditor is going to have to look for, and you're going to have to substantiate. You have to have that document. So don't make sure that stays within the compliance files, within the HR file, wherever you need to keep it, that you can't forget about it when the audit happens up to 6 years later. Yeah, this is a big deal. Okay, let's keep going. Next slide. Bonus incentive compensation, huge topic in the world. I could spend an hour just talking about this, but bottom line, you need to pay the bonus incentives are fine, but as long as you're doing it consistently and per essentially something that says that we have a bonus program. We do it either via discretionary or there's this formulaic approach, or whatever it is. It's got to be something that's consistent, and you need to be able to support why you gave certain people the bonuses they have. If you're giving significant size bonuses to people who are on performance improvement plans, don't think that's not going to be scrutinized. So what I want to make sure I convey here is, do you have to have all the rules and exact step-by-step how you get to each bonus every year and follow that rules? No, but you should have a regular practice. We meet together every year, we discuss everyone's performance, and the highest performers will get this part of the bonus and lower performers don't get any. Whatever it is, make sure it's a consistent practice that you can substantiate. Let's keep going. Next slide. So some best practices, like I've outlined here, and it can outline a whole bunch of different things. Know that it's okay if it says in the employment agreement, hey, if the CEO grows the company by 15%, we will give the CEO X amount of dollars. Yep, that'll probably be okay as long as overall compensation is reasonable. If it says specifically that bonuses are going to be paid at management discretion in offer letters, well, that'll probably work. However, if you decide to wait at the end of every year, decide, should we do bonuses every year? Should we pay out a bonus or not? You're just making it on a fly. I mean, yes, most contractors do have to make a decision, at the end of the year is happening, and how cash flow is and all those other factors. But our bottom line, it should be part of the culture that every year bonuses are offered. Not, well, it depends. It keeps depends, or we're just going to pay it out of profits. Yeah, that's probably not going to work. All right, let's keep going. Next slide. All right, compensating relates to changes in prices of corporate securities. This is an unallowable cost. Like I said before, you're expressly unallowable cost. So if you're giving out stock options, stock appreciation, all that kind of stuff that tech companies are often using, or startups, this is a great incentive tool, and doesn't mean you can't do it. Just don't think you can charge the government for the cost of issuing these rights, because as you may know, there's lots of easy ways to manipulate these costs, and the government doesn't want any surprises usually. So anyways, move on. Next slide. So limitations on allowable compensations is very important to know. I know this is getting a little bit aged, but at this point, if you have any contracts issued before 2014, there's one set of rules for how the cap on which employees can be paid, and then another set of rules for the amounts being paid after 2014. Next slide. So here are the outlines of those limits. As you can see, the pre-2014 limits are a lot higher than what they are today. The more recent, and this depends on when your original contract was let. So if you have a 5-year option contract that was issued June 1st, and you just finished it last year, you're still under the old compensation limits. However, any other contract awarded after June 24, 2014, the cost that you claim, direct or mostly really in this case indirect, you got to look at the cap amounts that are shown in are on the right. And what I've shown in that little table, that as of FY 2018, what's been published at OMB is 525 as a cap for executives. We've done the math for you, and even though it hasn't been published, the Balanced Budget Act that made this change in how executive compensation works at government contractors, we've done the math, and we've come up to 540 and 555 and 19. I'm sorry, the second number should say the 2020 cap is 555,000. All right, next slide. All right, professional and consultant service costs. This is a highly scrutinized area. When auditors come in, the first thing they'll pick up within G&A pool besides executive compensation is professional services. And as we all know, auditors and consultants are out there and charge lots of crazy rates. And well, here I am. I'm the consultant that's probably among those. But it's very important that when you're negotiating with these consultants, that you have a very distinct statement of work that outlines exactly what that consultant is going to do. So know that as long as they stick to the statement of work, the activities within that statement of work are allowable activities. So again, remember I was talking about before, you have an agreement, and you follow all the necessities of this bar cost principle, but ultimately that consultant is giving you advice on how to do general advertising, brand enhancement. This professional service cost might be deemed as an unallowable cost. So know the difference between a professional service cost as contrasted with purchased labor, which is someone who's more, I would think, more like a temp agency type of employee versus a subcontractor who's someone who's doing work on contract. So let's not confuse the difference between those. So let's move to the next slide. So what are those special considerations when you're looking at a professional service, and what are they doing? Are they providing advice? Are they providing recommendations? Like I said before, it's got to be for allowable activities. Are they actually managing and supervising personnel? If they're doing that, well, they're probably not a professional service anymore. They're more like a subcontractor. So know the difference between the two. You're going to have to document, well, why did you approach this relationship like this? Why is this a reasonable cost? I mean, this is all very important no matter what type of cost you're incurring, but you need to have that kind of documentation in order to substantiate it. Let's keep going. Next slide. Travel costs. Travel is also a very highly scrutinized area, though these days in early mid 2020, not many people are traveling anymore. But you know what? I'm confident we're going to travel again. We're going to get out there. So this bar clause talks about all types of travel costs, from air, ground, and I guess on water too, and all the associated miscellaneous costs. Next slide. So how is travel permitted? And, what regulates what government contractors can do? Within CONUS, we're looking at the federal travel regulations and the per diem rates outlined there. If you're doing OCONUS, it goes to the joint travel regulations as issued by the Department of Defense. And if you're doing anything else overseas, so OCONUS really is just Hawaii, Alaska, and other territories, whereas totally overseas, going to a foreign country, you're going to be looking at the state regulations for some guidance. And does this mean that government contractors have to follow all this? Well, let's talk about that. Let's move on to the next slide. So do they also, all government travel rules apply to all contractors, right? No, not necessarily. The government travel rules are meant for government employees, and being a former government employee myself for 8.5 years, yeah, I got to know the JTR and FTR really well. However, as government contractors, you're asked to maintain your own travel policies and asked to abide them. But I'm here to tell you, remember that reasonableness thing I talked about earlier? Yeah, it's hard not for a government auditor to use the guidelines in which they're looked to abide by and compare it to what contractors are. So something to consider. But what's specifically called out in this cost principle is that lodging, meals, and incidental expenses should be done, measured against maximum per diem rates as outlined that you'll find on the GSA website and the other places for the other rates. But just know, yes, you can go over per diem, and often there are contract terms that say thou must get the core COTR's pre-approval, or when you have to go over per diem, or even if you have to travel at all. So remember I said before about allowability? Contract terms matter. If you don't do that, the government can come back, and even though you did a perfectly planned trip, did a great work, you stayed under per diem, you saved a ton of money by finding a great deal for rental car on Priceline, whatever it is, yeah, the government can still disallow that cost if you didn't get pre-approval from your contracting officer's representative. So be look out for that. Anyways, keep going. Next slide. So per diem includes what? Very important to know. So if you're traveling domestically, lodging, taxes, laundry would be totally separate. Whereas if you're going to Hawaii, laundry is actually included within M&IE. But if you're going overseas to Indonesia, well, your lodging taxes are now included within that per diem rate. So just so you know on these kinds of items. Next slide. So what are the things you need to consider? Like I said, the per diem location, I think airfare type is a hugely important issue. First class travel is generally going to be a no-go no matter what. Business class could be okay. As of now, it's, for certain trips over 14 hours and some other rules on that. So make sure that you're following those rules in order to, when you're flying or even taking a train. I mean, these things are very important that auditors are going to be looking out for. And then just following your corporate policies on authorizations and, if they, when we're allowed to travel, if you're going to a conference that's been scheduled for a year and you decide to book it the day before you go, well, you better have some darn good documentation about how someone dropped out and you wanted to fill in. That's why you paid so much for that airfare. Or else, then governments come back and say, why am I spending $500 more on this airfare ticket when you could have booked this months in advance, which would have been much cheaper? So things to think about when travel is being claimed. Keep going. Next slide. So what are my best practices on allowable costs? I know you can't be overdone and oversaid in government contracting. Not only with contracting itself, but within accounting. Document, document, document. When in doubt, document. So no, for real. Lots of these areas that I spoke about today and others. When you're sitting there thinking you're on the fence about whether or not to claim a cost, you may want to attach something else to that voucher or something else to that agreement or something else in the vendor purchase about why this cost was was unusual, why it was substantiated, why was it reasonable. You got to be able to, because when this stuff gets audited, like I said, the government has up to 6 years audit of stuff, and many times you're going to have some kind of turnover within the accounting or compliance department. And they're going to be like, yeah, I wasn't here. I don't remember why we did that. Well, it better be in that file. So that segues into my second tip about training staff regularly on unallowable costs. So, like, what are your firm's policies about unallowable costs? And yes, I mean, obviously they should follow FAR Part 31, but I know a lot of my clients, will say, hey, listen, if anything, smells like it could be interpreted as an unallowable cost, we're just not going to claim it. Depends on how you guys are going to do it, but bottom line, have that regular training. And quite frankly, if you look at the DFARS criteria for having an acceptable accounting system, obviously one of that criteria is about having internal controls to detect and segregate unallowable costs. And one way to do that is make sure that staff is adequately trained. So not only have the training, but document who was there, what was the agenda, what did you cover, and be able to prove out, oh, there I go, talking about my documentation again, that training did occur. So look, hey, government, I've done everything in my power to make sure that we're making sure that unallowable costs are being segregated and not claimed on federal costs. Third best practice is, to be consistent and aim to properly segregate at the time of transaction entry. Yes, one thing I did not talk about, and I don't want to confuse you all, but you could, you could record all costs as they're incurred, and then at the end of the year, do statistical samplings and in order to take out unallowable costs. You could do that, and depending on your volume of your transactions, your high volume transactions, you only do 5 to 10% of your work for the government, and maybe that's the better way to do it, because you get to train an accounting staff of 50 on unallowable costs just for 5% of your business. Is that really worth it? Well, maybe not. So you could do that, but many cases, if not, I would say most cases, I think it's best and practiced at the time of transaction entry when you're recording these AP vouchers or journal entries, identify the unallowable costs right up front. Have formalized policies and procedures on unallowable costs. I can tell you that no matter what size contractor you are, you want to have an acceptable accounting system for accumulating, reporting, and billing costs under cost reimbursable contracts. One of the first things that an auditor is going to ask for pre-award or post-award is for your policy and procedures. And the most important policy and procedure is going to be about unallowable costs. How will your company treat it? Make sure those unallowable costs, that if they were allowable, they should have been within a base of an indirect rate. Well, make sure that stays in the base of that rate. And that's whole nother topic for another day. So, but have those positive procedures to manage that. And finally, when in doubt, throw it out. I can't tell you how many calls I get a day that says, Jeff, you know, we're having this get together. You know, I really want to improve my team's morale, and you know, I'm going to buy some snacks for them, and we're going to give this employee an award for being with the company for 20 years. So there's lots of little things going on there that, yeah, you probably could get away with it. And, you know, depending how much is being spent, you know, if it's a $50, $100, you know, I come back and say, listen, you know, if you feel like you'd be okay writing that check, God, for, you know, if someone wants to dig that low for that small of amount, you know, maybe you do it and claim it. But another great policy, I think, instead is say, listen, if anything is smelling potentially as being something is unallowable, just don't claim it. It's just not worth the hassle. You're going to have to spend hours going back and forth with the DCAA or another auditors explaining why, oh no, really, this was a morale, and you know, this wasn't actually entertainment. It was in the like, you really want to go through that pain? So keep that in mind. All right, next slide. All right, so I got a handy dandy guide that if you go to our website, which you can actually get to by going to govcon360.com, we have a tool that lists out the common selected costs that are covered within the FAR 31 principle, and you can get the feel for, you know, what's allowable, what's unallowable, and you'll see, going quickly scanning down the list, there's plenty cost principles that show examples of allowable and unallowable. So a lot of it depends. And AWR, meaning allowable restrictions, if you can claim this only if blank. So yeah, so lots of things to think about and to consider. You're gonna have to read FAR at times. So if you start with this, you have this posted next to your desk when you're doing your AP vouchers. Yep, that's a good start, but you're gonna have to start reading details to try to determine whether or not there's enough gray area for you to claim the cost as allowable. And I think that just about wraps us up. Next slide. I'm sorry that I wasn't able to interact with you during this session, but I would love to hear any questions you may have. Please reach out to me via that email or phone number. Love to work with you and help you out if you have any questions about my presentation. Otherwise, you know, I'd like to thank Jennifer Schaus and Associates for inviting me to present on FAR 31. Thanks, everyone. Hope you learned a thing or two.
All right. Thank you so much for a great presentation, Jeff. Really appreciate your time. To our audience members, thank you again for participating with us. And if you have any questions about this part of the FAR specifically, you know, please contact our speaker with the contact information you see on the screen. And if you have any questions about federal contracting or need assistance with any of our services, please contact us directly. Thank you again for joining us. This concludes today's webinar.